money 60% and utilize it somewhere where you can better returns from the NPS. Because the NPS, the handicap, if to my limited understanding, is that equity, corporate and government, now securities and all. So if the interest rates goes up, the yield goes down and all over there. I'm sure Mr. Kotarji will be aware in 1 year, most of us switched over to equity and corporate at the most. So what my submission is that it's not possible for us to minutely check each and every, what should I say, element of our investment. Having said that, we need to look into the people who are managing our money on behalf of us, whether it's SBI, HDFC, ICICI and all, whether they're able to walk the talk, whether they're able to generate returns, much more which we could have done individually. So going this way, I don't see much and all over there, but then I'm a very active investor. But there are different types of people, different types of investors. Some people would have loved to, leave it as it is and let it run and all. But if you look at the history of mutual funds, if you look at history of all pension fund managers, ultimately where they invest. And second thing is that, do they generate enough returns to beat the inflation? That should be your query. Like whenever you're investing in a PMS house or a mutual fund or any direct investment or in any other segment, do you actually compare the services which have been offered vis-a-vis if you had done on your own? That said, do you really feel like if you are giving 1%, 2% of your hard-earned money to those mutual fund managers and they invested in Zomato, don't you think you have a right to ask them like, what basis they invest in when a company which they don't have any value? So these are the very personal choices. I leave it to the individual concern. But having said that, our investment industry needs to mature a lot. The only reason why they are getting away with it is the very fact that the financial literacy in our country is very poor. If you have a financial literate country and all over there, you will definitely see a different change of our investment horizon, investment products, and there's a lot of other things. But then that's a long debatable discussion we can do any other day. But let's see, I want to cover as much as ground as possible based on my limited understanding and based on my experiences over the last 2 years. And I like to share it in a very simple form. I'll try to keep it as simple as possible so that a layperson can understand. My only humble request is that just bear with me while I go through my presentation and all, and it will be divided into 3 parts. The first part will be basically on how I interpret the market. The second part is that I will take you around on exactly the process which I follow. And the third part will be the lessons and learnings. After that, the floor is all yours for questions and answers, which I will try to the best of my limited knowledge to answer it as much as possible. I'm quite surprised, 105 participants in near 20 minutes. It's quite a large number.
It will be minimum 150 by maybe 10:30. Mitra ji, one simple question on the NPS. Now, I have a dilemma. I am at the age of 63, assuming, and I have something around 50 lakh rupees lying in an NPS. Okay. Now, what you will do, or what is your suggestion at the age of 63, whether I should take the annuity or not, because and whether I keep invested and then I wait for another 2-3 years because the market is going up. What the question Mr. Ramakrishnan also asked, or should I exit and put that money in the equity mutual fund, or maybe in my that equity call and put and all those things where I can generate much more return. So what is your suggestion on that?
Sir, I understand the question, but with very limited knowledge, because one has to look into the liabilities of the person and the would-be expenses for the next 10-15 years. But assuming that everything is under control and there's no debt, there's no outstanding liability and all, my submission will be to withdraw the money. The reason why I'm saying is that, see, all of us know that India's GDP will grow. And in fact, if you look at the history of India's GDP growth right from the first day, and then look at the history of the NSE market cap, when it was established in the year 1992, or even if you go back when BSE was the only platform, you will realize that one thing, when an economy grows, it takes 7 to 8 years to double. But as the space picks up, like if you put it in stock market jargon, if the economy moves to stage 2, then the GDP starts doubling every 5 years. Now we are in the position, if you really look at it, India is in the last 10 years, we have been the top 10 largest economies. Okay. Now we are moving to the position of 5th. By the year 2030, we will be in the 3rd position. And in the year 2045-50, if all goes well, we should be in the 2nd position.
Oh.
So my submission is that when you know the broad indicators that the India's GDP will go, you can always put the money in Nifty Bs. That is the safest option. And if you know a bit of technical, you know when the market is going up, when the market is coming down, depending upon the whether it's a recession, there's a bull market, or even there's a what should I say, sideways market. You can pick and make a call, because you know what I personally believe: if you invest your own money, you hold yourself accountable. If you invest through somebody else's lenses, then what is happening is that you are withdrawing yourself and you allowing that person to take a call on your hard-earned money. If you are a literate investor, if you are an intelligent investor, if you are active, if you are aware of your market, if you're aware of the macroeconomic conditions, if you're aware of the sectoral trends, then I feel it should be injustice to give your hard-earned money to somebody else. It is better to manage it yourself. But then with the caveat that depends upon your passion, your other interest in life and all, you might outsource it. That's entirely individual call. But if it was me, I would rather handle it myself. Thank you.
Okay, good. Yeah, but when you say the GDP will double, what do you mean by that? The GDP growth is 6% only, na? Then how in 5 years it will become double? Well, how you are making this statement that GDP will double every 5 years? Can you just explain?
Sir, I will share in my course of the presentation and all over there. But if you really look at it, just look at this, we have worked all in the industry, most of us. If you look at the fuel consumption in the year 1991, when Mr. Manmohan Singh and Mr. Narasimha Rao liberalized the economy, and look at the fuel consumption today, you will understand what I'm talking about. The entire fuel consumption of the country is equivalent to now one state's fuel consumption.
Mm-hmm.
So if you have a long-term picture in the game, say we are the world's largest population, whether we like it or not. We will not go old. I think China will get old by 2026. India the aging population will be around somewhere in 2035. The aging population will be more. So we have got another 10 years ahead of us where the GDP can go. But and that is the reason why I'm very optimistic and all over there. But I will try to answer it in a different way at the end of the presentation.
Okay. Now you can start with only 10:26. So you can, if you want, you can start your presentation. I'm giving you 1 minute. I'm giving you that sharing right.
Host facility.
Right.
Yes.
Just 1 minute.
Good morning, Kothari and all participants.
Yeah, good morning. I've given you, sir. Tiwari ji, good morning. Yeah.
Give it to me. Can you see my screen?
I can see. We can see your. Yes, we can see now.
Okay, fine.
Make it in presentation mode. Mode.
I would request everyone to be in mute mode and all over there, because I try to keep the flow of the conversation as smoothly as possible and all over there. And in case I miss something and all over there, I will try to come back and answer all your queries at the end of the session. You may put your queries in the chat box also. So when I go back at the end of the presentation, I'll be in a better position to understand where your queries coming from. And I will hope to answer to the best of my ability.
Mitra ji, I have disabled this mute and unmute option for the participant. So now you can speak at your will. So nobody will be able to interfere in between now till I change the option again. Don't worry. Okay. Yeah.
Okay.
Uh,
Good morning, everybody. First of all, thank you for inviting me to this, for sharing my learnings with all of you. And before I begin, I'd like to thank Mr. Kothari for not only providing this platform, but for being a mentor for so many years to so many of us across different sections of different parts of the equity market, be it future option, be it currency, be it commodities, be it in equity and all over there. And believe me, I've learned a lot from him and all over there. Why I like to say this is that all of you who are old-time members of Financial Freedom Group knew that 2 years back, Mr. Kothari introduced the concept of monthly earnings. And that time I just took early retirement for BPCL, and it just made me think, Mr. Kothari is saying this, there must be something to it. So I started understanding the market in a deep way and all, whether I'd be able to earn on a monthly basis and all. And touched wood, by the grace of God and by the well wishes and all over there, I've been in a position where I can safely say I'm much more comfortable than when I was at the time of retirement. But having said that, having gone through the journey and I have counseled a lot of people and all over there. I've been to different investment communities and I've spoken with them and all in India and abroad. There are two things which I feel that everyone should be aware of and all. So when we talk about finances and all, we basically keep it within ourselves. We never share it with our family members. So my humble submission is that share all your finances with your family members, because it gives you different insights. Not only that, they also start learning and understand the value of money. So that said and all, as I said, to those who have joined late, my presentation will be basically on 3 parts. The first part will be my observations of the market. The second part will be the process which I follow. And the third part will be the lesson and learnings which I have learned in my equity journey. And please remember, I'm in equity, I have only dealt with cash equity. I have never, what should I say, done any future and options, no currency, no commodities. And I believe in cash, and that too, not even intraday. It's more like T+1. It earlier was T+2, now it's T+1. So whenever I used to buy something, I used to give a lot of thought in the process of why I'm buying, what is the rationale for buying. And after that, I have started. Over the 2 years of my investing journey or equity journey, I have evolved a lot, in the sense like earlier I used to, run off of indicators, signals, listen to what is the latest, what is the hot stock, whatnot. But having said that, what I have done is that now I have reduced it to a bare minimum. And like most of you, I'd hardly watch any TV or even any newspaper for that matter and all over there, because I believe in assimilating the information to the best of whatever the limited knowledge I have, and that has worked out significantly well. The third thing which I have realized in the course of the journey is that, if you keep it simple and if you understand what you are doing, it gives you a lot of confidence. And ultimately, the stock market is nothing but a game of probability and risk. If you can manage the risk, you'll be a winner very soon before you realize it. And one needs to work upon one's psychology, which I will touch upon my presentation. This is one disclaimer statement which I never used to put in my earlier slides, but I realized I need to share it with everybody. Please understand that equity markets are inherently risky and it's not meant for everybody. Because each person's risk appetite is different. Some might be very aggressive investor, might be a very conservative investor, and there are different types of investments available. So whatever, and I'm not a SEBI registered advisor, so I don't proclaim that I have enough knowledge of the market. I'm a student like most of you. What I'm doing is that I'm sharing educational purpose. I'm sharing all the examples, so you can pick and choose whatever suits for you and all. And please remember, equity market, the past performance is no guarantee of future performance. All of us don't know at what rate the market will open tomorrow and when it will close. So keeping that in mind, please remember that whatever happened in the past will not happen in the future, because circumstances change, the geopolitics change, the macro factors change, and those are always inbuilt into the price. One thing which I realized over the years is that, like the stock market, the price actually reflects the total news which is flowing out from different sources. The reason why I'm saying is that I've realized that the markets have got an uncanny idea 3 months, 6 months before, at least 1 quarter or 2 quarters before, what the economy is going to be like, what companies will do well, what sectors will do well. And if we cut out and filter out all the noise emanating from the market, we'll be in a better position to understand how is it happening. And the last request is please kindly consult your registered financial advisor before investing in the equity markets. This is something which I fundamentally believe, like what is stocks is nothing but an equity, and it's at a certain value, but the stock price going up and down depends upon fundamentally the number of buyers and sellers. It's a classic economic situation of demand and supply. If you have less float and a very good company, obviously the share price will buy. On the contrary, you have a company which is going down, there's got no future, nothing and all, nobody will buy. And if you have bought it, if you buy more of a company which is going down, you will not find any buyer at all. So recently we have seen what the last 3-4 months, how the industrial house, how their stocks actually fell down and all over there. So that writing was given in the Wall 6 months back and all. If anybody had observed, they would have understood how the market is going to react if any negative news comes of it. So what my intention of showing this slide is that if you buy something and if you don't have a seller, that means your entire investment is stuck. There have been moments when I found that I bought a certain stock and I found that I was the only buyer of that particular stock for that particular day. And it took me 5 months to come out from that stock because it to sell only 1%, 2% every day to come out of it. So the lesson what I'm learning is that if you are a trader and investor, go for very liquid stocks where you can sell, it at least it should be more than 50,000. Because what happens, anything below 50,000, you have seen how the micro stock cap stocks behave. And a lot of people gung-ho when it goes up, 5% every day and all. When it comes down, it equally comes down by 5% and all. Normally, I try to stay away from the stocks because those are basically cases of extreme demand and less supply. Again, excess supply, less demand, which does not do any justice to the company. This is the most important slide of my entire presentation. Please understand, in the stock market, it's only the psychology which is the most important. Why I'm trying to say the psychology, assume that all of us present in this forum buy 10 number of stocks, say given a hypothetical example of Tata Steel at the same price. Do you think all of us will sell at the same day at the same price? The answer is obviously no. The question is, some of us will buy more, some will sell less, some will switch over to other stocks and all. But try to look, if you are a big investor, put yourself in the shoes of a big investor, not a retail investor. Do you think when Mr. Rakesh Junjula started in the year 1975, for 9 years, he did not make any money. Even Warren Buffett did not make any money. Look at Jim Simons, the guy who invented quant investing, the algorithmic thinking. He started at the age of 51. So what I am trying to share over here is a very fundamental premise that even big investors faces turmoil in the market, which retail investors does. Does it mean they offload their entire quantity? Obviously, no. If you look at all the big investors in the world, and if you study their investing pattern, I will share the book list with you. And if you go sequentially over the 5 years, 10-year periods, you will understand they have concentrated their stocks in 4 or 5 companies. And the rest is only 1%, 2% and all over there. And the reason why I'm trying to say is that it's okay. You want to emulate very investors, be it Mr. Vijay Kadia, Mr. Ashish Kauchal, you're welcome to. But please try to understand the lens through which they are observing the company and the lens you are in a company are totally different. because each person has got their investing style. And I personally believe there might be 1,001 investing styles. I might only capture 4 or 5 of them. You might be in a better position to understand 80, 90 of them. But not each individual style is meant for everybody and all over there. Each one has got their own pace and all. But one thing which I realized is that each of these investors have, they have attuned their mind to the fact that they have actually invested the money which they are not going to need for the next 5 years. Just look at this example. Assuming you are investing a money for 5 years, you don't want to touch it. Don't you think your psychology will be more strong than a person who needs the money after 6 months? So the idea is that you can train how you can build up your psychology. Is that the way I look at it? Is that how to minimize risk? If you can minimize risk, then obviously your body, your propensity tends to the fact that you will always take a conscious call before making any investment decision. You will always evaluate the pros and cons, not go by the tip or go by what you saw on the road or heard from the TV channel and all. You will use your own inherent wisdom in understanding whether the stock is for me or not. The reason why I'm sharing this, that as a retail investor, if you have a life insurance, a term insurance, if you have a health insurance, if you have got an emergency money for the next, say, 18 months or 2 years, and you don't have any liabilities, and you can keep the money invested for 3 to 5 years, you'll be in a much better position and compared to nearly 99% of the other investors in the market. The rationale is that the market always gets an opportunity to come out. But if you are looking for investing for 6 months, 1 year, 1.5 years, you will not get the wealth which you deserve. So that's what I'm trying to say. The second thing, fundamental analysis, technical analysis are very bare minimum. Yes, we need to learn that. But the risk management is ultimately your money. It's the way you only control your destiny. You can't blame it on the market. You can't blame it on the investment house. You can't blame it on the mutual fund manager. You can only blame yourself. The sooner a retail investor realizes this and has the propensity to learn and decide on how to fish, the person is set for life. It doesn't have to look for help from anybody. See, most of us have this decision problem, and I have covered it in the course of my presentation. What to buy? Do I buy Nifty 50 stocks? Do I buy BSE 500 stocks? Do I buy Nifty Junior? Do I buy Nifty Mid Cap? Do I buy Nifty Small Cap? There's a plethora of options. So you have to decide, and I will show you how you can decide. There are certain parameters which I do to decide which are the stocks which I will look for, which are the stocks I will avoid. When to buy? Now, I am a contrarian investor. People who know me, I am a contrarian investor in the sense that I always buy when the stock is written down. And where sentiment overwhelms in the market, where there's nothing fundamentally wrong with the stock. The people realize the stock is bad, they dumped it, and all of a sudden the stock reaches the 200 MA moving average or even 300 moving average. And I look at in this thing, has there anything fundamental change in the company? Has the input cost gone up? Has the product is getting affected by other competitors? Whether they are able to retain their margin, whether they are capturing new markets, whether they are taking over some other company, or there's some bad news of corporate governance and all over there. So these are the, what you call special situations. Actually, I look for special situations and all over there. And I always sell when everybody is buying. The idea is that I never sell. Selling is also a trick. All of us, we know how we enter. But selling is also something which you need to understand how to sell and all about that. So which I will share subsequently, how much to buy. Now, normally what I would advise anybody, and what has been my understanding so far, is that assuming you want to invest 1 lakh in a particular stock, assuming. So I would suggest that you start investing with only 10,000 rupees and see how the stock behaves. If the stock has gone up, you can add another 5,000 rupees. What I'm trying to say over here is average up. It never averaged down. In fact, I've seen investors like when the price comes down, they double on it. They buy many of the stocks. Like you've got Kingfisher, you've got DHFL, you've got Suzlon, you've got Unitech, you've got so many, a plethora of names. Even Reliance, I think petroleum, not petroleum, the Reliance Power. So my submission is that learn from your mistakes. Everyone makes mistakes. I make mistakes every day. In fact, all the great investors in the world have made mistakes. But the only thing that, many make a mistake, learn from the mistake. If you maintain a trading journal and if you give the reason, like this is the point which I'm entering, this is the point I will exit. You decide on your entry price, you decide on your exit price, and you give the rationale for entering and you give the rationale for exit. If you do it over 50 trades, at the end of the year, you'll be in a much better investor or a trader as you want to going forward. So my idea is that don't buy everything at one go. You can buy everything at one go when there are certain situations which will allow you can put all your capital. But ideally, one should not have more than 10 to 15 stocks in one's portfolio. That's number one. Point two, not more than 10% allocation to a stock. Secondly, not more than 30% allocation to a sector. Because no matter how good a sector, like IT sector, you have seen everybody invest in the IT sector, all the employees of IT, they had their ESOPs, they had 60%, 70% of their entire equity portfolio was in IT. They never understood the risk of investing so much in one particular sector. So my submission to you is that at the end of the session, go back to your portfolio, look which are the stocks which you have, whether it makes sense to have so many stocks, because even a stock with 1% allocation, say, make it not even double, make it 5 times, will it have any significant impact on your portfolio? The answer is no. So you need to have stocks which have actually grown and you feel has got a lifeline ahead and all, you need to add more money to the stock. So you can get a better allocation, so get a better return. Because if you put, what do you call the famous saying by, I think Warren Buffett said it, or Charles Munger, he said that, you should water the flowers and cut the weeds. And most of the retail investors, what we do, we cut the flowers and we water the weeds with the expectation that the company will come up and I will recover my initial cost. That is called anchored in bias. And normally as an investor, the sooner we move out from any biases, the better we be free in our market choice and our market determination. When to sell, this again I will be sharing, and how much to sell, that depends upon the type of investor, whether you want to sell 50%, 25% based on your moving averages or based on your understanding of the market, of the company and the sector, you can do that. There's another decision problem which I've heard from many investors, including from my community, both from school, college, and university, as well as my professional life. Everybody wants to buy at the right time. Everybody wants to buy and really sell. Everybody wants to buy the top buys of today. And heaven forbid, never average down. Now look at this. Imagine 10 years ago, you bought a stock, whatever be the value, and look at the price today. The stock price will definitely, by and large, if it is a good stock and in the NSE 50, it will at least show some appreciation. Now, what I'm trying to say over here, at that point, 10 years back, the stock had a very high PE. Most of us stayed back, no, it has got a high PE and all, but we never thought that the EPS growth of the company will accelerate over the next quarters. So the PE will start falling. So the PEG ratio will come down to less than 1. So it's an attractive investment. All those also who have invested in Infosys, TCS, HUL, HDFC Bank in the mid-90s, they must have made a fortune. So what I'm trying to say is that try to understand when you invest in a company, you are investing in a business. You are investing in a professionals who will ensure that their company runs. And how do you decide which company will actually walk the talk? To that end, once you have narrowed down the companies, please read the annual reports of the company. Start from 5 years ago. Read only the director's report. Look at the chairman's report. Look at the profit and loss statement and balance sheet. And just come to recent. So once you do this for 5 years, you'll come to know whether the management promises or they delivers. and you can make your choice accordingly. You will come on to know whether the management has made provision to set up a factory or a refinery or some warehouse at one particular place, whether they've actually delivered it without any cost runs and all. So you will get a fair idea how company efficiently utilizes the finance or the working capital. What is the capital inflows? What are the capital outflows? How many debtors they have? The more you go deep, you have to build your own fundamental conviction of holding that company. Don't go by what everybody's saying in the market, like this stock is a hot type, it will double, triple. It doesn't work that way. Sometimes you'll be lucky, yes, but on the long run, you'll be the probability it will be less than 0.5. This is the most, the second most important slide which I want to share with you. Most of us retail investors, once it comes in the media, when it comes in the newspaper, there's a lot of enthusiasm. We start buying and we start pushing up the price. And it's always the last person who enters, he left holding the can till the next cycle begins again. So the question is, how can we be in the first stage? That is the stealth phase and the awareness phase, the smart money and the institutional investors. And these signals are there in the market. It's the only thing we do not follow it. If you go to the NSE website and you look at what are the FIs have been buying or selling, you will understand exactly where the FIs are doing it. 10 years ago, I would have given more weight to the FIs, but right now I don't. Why not? Because if you look at the Indian stock market history, 45% belongs to the promoters. And when the market crashes, the promoter adds more of their own stock. So basically 45% goes away, 45 to 48% roughly, if I'm not mistaken. And that what has happened, the retail investors, the FIs have now come down to 18.5%. You have for the retail investors, you have got DII, domestic institutional investors, you have got high net worth investors. Their total sum of this tree is more than the FIs. So if you think that today the Fed will say, I'm going to increase, Jerome Powell will say, I'm going to increase by another 0.25%, 0.5%. Will it affect the Indian market much? Yes, to a certain extent it will affect, because market is after all global capital flows. But please remember one thing, it will happen that sentiment might be 1 day or 2, but not wrong. So what I'm trying to say is that identify companies which will have a long runway ahead, has got a long vision plan, has the ability to go from a small cap to a mid cap to a large cap company. There are certain gems available. If all of you who are can look at the BSE SME exchange and look at the companies listed over there. Some are very professionally run, even they might be a SME. But who knows, after 5 years, they can be in a small cap. After 5, once they enter the small cap, then the mutual fund manager starts looking at the company, starts accumulating. That's how the price keeps going. So you should at least, I mean, if you are very thorough with the market, if you understand it is a man, try to identify the small nuggets, small jewels which you have and all. I remember 2 years back, who thought of Lotus Lab? Tripling. Now look at what is Lotus Lab now. It has come down. But at one point of time, we understood what the propensity of the earnings it will be. And the stage 2 cycle was so sharp that most of us wrote it. Secondly was NIIT. If I'm not mistaken, there were so many other companies and all over, all cargo logistics, I remember. So with a lot of people who invested made a lot of money. So the idea is that you need to identify the company. You should not buy it at a price which is overvalued. You will not get much. How much return you can expect from a large cap? 10%, 15%, 20%. But from a small cap and a mid cap, this is risky enough. But if you do your research, if you can understand the company well, and you know how the company is going to plan to emerge to the next stage, I think you will get a better return. That's what I want to share. And this is what is over there. Never get into a bear trap and a bull trap. This is something which is over there. Market is right now, what I would say is a sideways market. So in a sideways market, we should have different strategies than in a bull market, which I will share subsequently. these are the few basic things which I feel any retail investor should understand. How does the unemployment, inflation, money supply, exchange rate, interest affect the stock market? Because then you'll be a better position to understand when to pick a stock, when not to pick a stock. Now, if this unemployment increases, then obviously the disposable income available to the household, the wage, he will start shrinking. So the discretionary income will start, discretionary spends will start coming down. So only the basic utilities, the staples and your utilities payment, this all will be made. Similarly, when there's a inflation in the market, so what happens? The purchasing power erodes. So people again realize the same amount of money they have to buy lesser, they downgrade themselves. So instead of a brand, like if you listen to the con calls of Unilever, Nestle, Medico, so most of the investors and all over there, they're downgraded. So the FMCG companies, so they also reduce the packet size. So to ensure that they're within the same price limit, so it doesn't pinch the investor more. Secondly, when there's an inflation, now a company which does not have inelastic demand, means their demand is elastic, so they cannot afford to increase the price. So which means their margin will get eroded, which means they will earn less, they will show less profit, which means the earning per share will come down, which means the stock will come down. So what I'm trying to say is that always look into the 4 factors like what if, and then you will be able to answer the question whether the company is in a position to pass on the increase in their input cost to the end user, whether the company has got a moat, whether the company has got an inelastic demand, whether it's able to do so. Second thing is the exchange rate, how does it work? So obviously, if the currency gets devalued, the exporters gets a benefit, whereas the importers, they have to pay more. So all of us in the oil industry knows that what happens when the dollar price goes up and how much is a fuel bill, total imports, how much it goes up and how much we have to buy dollars and all over there to ensure that the crude flow doesn't stop. Similarly, money supply. So the more money you have in the market, obviously money will start going into different asset classes. They will move to the equity market because that's the easy way. That's what happened. If you really look at it, the post COVID, that last 2 years, there was ample amount of money flowing and all over there. So that led to increase in the prices of the stock. Then the interest rate. See what happens when the interest rate goes up and all over there. So normally people who wants to buy real estate, they have to postpone their choice either, or they have to shrink it into from a 3 BHK to 2 BHK. The only interest rates goes up, the working capital of a company gets affected because they have to borrow at a high margin. So if they don't have the sufficient inherent reserves, they have to borrow at a cost, which again eats into their margin. So what I'm trying to see over here from these 5 factors, like whenever you look into the company, put yourself in the shoes of the management and see what sort of results you expect to deliver, not only this quarter or the next quarter, and whether you have the ability to do that. Assuming, of course, ceteris paribus, other things remaining constant, but at least it will not harm, because once you start assimilating this process of understanding what means the company's next quarter's EPS is going to be, or the EPS growth is going to be, what was the base year EPS, whether it is a seasonal factor or whether it's a cyclical factor. So you need to get all this information before you make an investment decision. Then only you will be say, okay, I'm not saying you will be 100% right, but at least you will tend to be right more often than lose. Now, this is something which I have always shared, and on the left-hand side is the stock market, the right-hand side is the economy. So please remember, the stock market is actually 1 to 2 quarters ahead of the real economy. So normally we ask the question, everything is good, but why the stock prices are going down? Or we always have a look, like everything is down, the economy is down, but why the stock market is going up? Because there's a time lag between the two. So whenever there's a market bottom, people focus on consumer staples, healthcare, utilities and all. When there's a full recession, then again the consumer staples, healthcare, utilities. So the idea is to understand which particular segment of the economy is currently now, where it is heading to, and which of the stocks will be in demand and which of the stocks will not be in demand. Say, look at the year 2023, 1 year before the general election, which I presume will be next year. Now look at the history of the last 5 general elections. 1 year before that, which are the companies or which are the sectors which benefited from that? If one does the research, the answer comes out very clearly. Cement, construction companies, because the government of the day wants to complete all pending projects as far as possible, make the infrastructure, or so what happens like when the infrastructure goes, the cement, the import, the steel parts, everything starts going together. So what we are saying is that whenever you take a call, look at what happened 5 years previously at the same situation, and then you'll be in a better position to which companies or which stock market to pick. This is again, earlier I used to be a big fan of sector rotation, but right now I have tempered it. The reason being is that you can have a bad sector, you can have an excellent company. Look at FMCG business over the last 2 years, it was not going anywhere. Look at Tata Consumer Products, they did extremely well. Similarly, in IT space, none of the heavyweights, be it Tech Mahindra, HCL Tech, TCS, Infosys, Wipro, you name it, LTI, Mindtree, LGTS, Tata LC, none of them did well. But look at the small caps like, Saxoft or Acelia Solutions. They are also in the space, or BraidGain. They are also in the same IT space, but they are delivering to a niche, a vertical. So you have to understand which verticals are working, which verticals are not working, and invest accordingly. So by and large now, whatever I do is that I focus on a company. I never now focus on the sector, because there have been occasions where I was right on the sector, but I was wrong on the company. And I learned from my mistake. I said never again. Even if I look at the sector, I will look at what are the large caps, what are the mid caps, what are the small caps. Then what I will do is that I will look at it that what is the market capitalization, what is their profit, what is the share out of their profit in the total space. And I will try to say which of the companies in the last 3 quarters have increased their profit share vis-a-vis the other companies. So then my focus will go into those companies where I do my fundamental research and start investing on a small portion in each. So the idea is pick and choose. So it's not every strategy works for everyone, but this is the process which I follow, is that I have got a fair idea what is the total market cap of the sector, who are the main players, who are the customers, how much margin they get, what are the headwinds, what are the tailwinds, what is the mid cap player, what is the small cap player. Now this is very interesting to understand. Normally, if you look at the history of the NSE market cap over the 3 decades, it started in 91, nearly 3 decades. You will notice 2 things. Large caps were historically 85%, and the mid cap and small cap was historically 15%. Right now, when I'm speaking to you, large cap is 92% and the mid and small cap is 8%. If the economy goes, it's my understanding the mid cap and small cap space will go even much faster, because they will move to the next market cap. So the most of the growth expansion will happen in these places. So obviously the stock prices will rise much more than compared to other stocks. It's not that the others will not rise, they will definitely rise, but not to the extent. If you want to make alpha from the market, then we have to understand what is the beta of a stock. And once we understand, then only we can actually plan or allocate our money. There's no point in putting 1% allocation to a high alpha stock, knowing you are an aggressive investor. Even if it triples, you will not make a dent in your portfolio. So the bottom line is that understand the stock, understand the company which you are investing, understand what is the future is going to happen in the next 3 quarters, and plan accordingly. This is the golden rules which I only follow, is that if I want to invest in a company, I do the entire research by myself. I don't get influenced by Bloomberg, what Bloomberg says, or what Economic Times says, or Washington Post says, or Washington Journal says, or even all other foreign channels. The idea is that everybody reports based on the hindsight. It's ultimately my money, so I have to invest based on my own wisdom. And if I have to make a mistake, it will be a part of my learning. So I'll never make that mistake again. So I always do my research before I invest in a company. I always ensure, I always believe in the Pareto principle where 20% of your stocks will give you 80% of the returns. And that actually happens. So if you've got 10 stocks, 4 stocks will be, dots, might not take off, but 2, 3 will do, which will be enough if you have allocated it in the right size at the right moment. Assuming when it hits the Bollinger Bands or when it hits the Donchian channel, then you can allocate more money and you can average up. But if you have not run all over there, so is that risk management discipline in following one trading plan, and with your knowledge and experience, it's possible to create alpha in the market. Now, a lot of investors ask me, what is alpha? Now, my takeaway from the Indian economy is that I always try to aim for a return, which is the GDP growth of the country plus the inflation rate. So I should top that. So normally, assuming the GDP growth of the country is, say, for hypothetical purpose, is 7%, and your inflation rate is 7%, one should look for at least a minimum of 14% from the equity market. Because otherwise, that's the own benchmark which I follow. It's not that I always succeed, but most of the time I succeed. So historically, I like to have a double-digit return. And because it takes care of the inflation, it takes care of the fixed deposit rate, interest, and all over that. So you have some cushion even for the emergency days. And I always believe in one thing, believe in data, because data, actually reveals much more than what news or any investor or financial influencer says in the market. Because once you understand how to look at a candle, a price candle without any indicators, you will know what the stock is trying to say and communicate to you. It's only, when you pick up the Japanese candle, the way the Japanese candles have evolved. If anybody is interested, I will share the reference of the book. You will understand that a candle by itself gives complete information. You don't even have to go to anywhere else. Just observe the candle and you can make a bet on the market. And last but not the least, selling is more important than buying at the right price. That, as I mentioned earlier, I'm a contrarian investor. I always sell when there's momentum in the market, so I can get it out at a higher price. Yes, the stock might go 10%, 15% more, but then that's enough. You should leave something on the table for the next investor. And you should be content with what you have, because once you enter the stock, the way I do, when I enter a stock, I am very clear what is my exit target and what is my loss target. Normally, earlier, I used to have an 8% stop loss. Now, in a sideways market, I've trimmed it down to 3% stop loss. So the idea is that if it hits, I come out. So, and taking losses, or if you absorb losses, I think that's the hallmark of one of a great trader or investor, because the ability to take losses is that one should not have any ego in the marketplace, because the market believes a different story and you believe, no, this company will do well and all. It doesn't work out that way. The question is that if you believe you have done wrong, cut your losses, come out, put it in some stocks which will gain. But the idea of holding on to the stocks and losses over the years of decades, just imagine the opportunity cost of capital lost. So my submission will be that, it's very easy to say, but painful. But once you go through that with smaller allocation of money and cutting losses, you will develop your own investment psychology, which will help you to earn more returns going forward. This is what I had shared earlier. I'm sharing again for those members who have not seen my previous presentation. It's like most of the common question which I face across board is that how much how can I double my money? How can I triple my money? Now, that's a very ambitious goal. It's good, but one should have a framework to understand how it can be done. So in a bull market, you can get 2 stocks, which gives you 40% return, you get a 90% return. Even a 420%, 107%, but that will not work in a sideways market or in a bearish market, right? So when the global macro indicators are not very recession heavy, even the World Bank or the IMF, they have downgraded the global growth from 3.3 to 2.2. And when all the anticipation of China opening up and all over there, but China has got its own problems. The construction sector of that particular country is again in the doldrums. So unless they clear up the construction sector, the imbroglio which they are in, ensure that liquidity flows again, and then only they start, consuming more iron ores, then only India, the mineral players will able to earn more money. So that's a catch-22 situation. But coming to that is that one needs to temper one's expectation based on their own style of the market. So this is what, it's a simple Excel sheet, like you can understand how it's calculated. This is what I normally follow for the last, say, one bear market or the sideways market. I've been following this 5% principle. Like if a stock, when I enter a stock, and I'm sure if a stock gets 5% and I see there's no further run, I exit. If a stock goes to 3% and I say again there's no run, I exit. My stop loss is only 3%. If I hit stop loss in one day, I come out. So what happens is that I realize some stocks behave in such a manner. It's like you know how to ride a horse. The horse will throw you off. But after a certain time, the horse also understands what is the rider's psychology. And the rider also understands what is the horse psychology. And they start riding together. So it's like that. It's not that every time you enter, you'll be right. You start small. Instead of 10,000 rupees, start with 5,000 rupees. Learn the ropes. Then start better. Once you build up your confidence, you build up your trading journal. Once you have more understanding of exactly what moves you, how the stock behaves, what are the, the rare chances of entry. See, this is one thing which I have practiced for the last 6 months. Fortunately, my number of, what should I say, stop loss has been hit is now less than 6%. So I have actually understood and evaluated my own methodology of understanding what works in the market for me based on my limited understanding and what doesn't work. So I always enter in a position where I am comfortable. The stock will not go below this point, but will at least give me 5%, 10%, 15%, 20%, 25%, 40% return before the rest of the market catches up. This is, I'll just go to the next 4 slides and I will show you the actual process which I follow. See, my methodology, especially when the interest rate started rising and a sideways market, I focus on companies where the debt equity ratio is less than 1 and increase in EPS growth. It's absolutely very simple to understand the rationale why I follow this. Because obviously, if a company has got its internal reserves to fund future capex and all, it doesn't depend on the market, it'll be in a better position to deliver more returns to the stakeholder than a company which borrows on the market and all over there. Sometimes it might click, sometimes it might not click. I'm not saying a debt borrowed is bad, but the question is that whenever a company incurs debt, that opportunity cost of capital, the company is not gaining till the factory or the line, the secondary line and all comes up. So, and if you look on the capex point of view, most of the private sector capex has not happened. So what has happened is that the government has actually, expanded the economy, be it construction, infrastructure, everywhere, ports, everything as the government has started to do. So once the private capex picks up and all over there, then that'll be an interesting story. The second thing which I've done is that focus on very low risk entry points, buy when nobody is buying, buy when the smart money is buying, buy when institutions have started buying in tranches. And I will show how institutional buys at what point of time, what are the time slots you need to observe from 9:15 to 9:30 and 15 minutes before the market closes. The other thing which I follow, and most of my people who knows me, knows I follow the Heiken-Ashi candlesticks and RSI 14-day EMA crossover. That is one of my major indicators whether the stock is going to do well or not. And I'm a contrarian in a certain strength, and I have absolutely no FOMO, fear of missing out. Even if a good stock goes by, I say absolutely nobody, because I know exactly what I'm buying, what price I will exit, and at what cost it has incurred for me. Yeah, I'll just give you a few examples which I have invested in the last 1 or 2 months. This is, look at this, the curve. It's called Econ International, right? Most of you have heard of, I mean, a lot of companies in the defense space, which also BDL, Garden Ridge, Cochin Shipyard, Bharat Electronics. There's a lot of other companies also in that space. They made a lot of money. Then the railways. So once we understood the question of the railways, how they have been changing, the investments, the number of trains, the new locomotives, which were coming and all over there, we understood which were the companies. In fact, 2 decades, I would say 21, I recommend that we discussed in Financial Pyramid Group, the second was TWL, Titagarh Wagon Limited. Today, what is it now? So those people who had invested, and they must have tripled their money by now. So the idea is that once you have a fair understanding where the market or the sector is going forward, you can take a call. Now the question is, at what point I took this? Okay, the question over here, when I realized, when I talk about the railway sector and the bus, and I found this volumes have started increasing. The green train has come in and all, and the stock is actually, the 3 very strong sides and all. Then I realized it's only a matter of time, because over there, and also look at this RSI, this is crossed over. It was a slight dip, that's what it's called, the bull trap, the bear trap, and then again it started moving. So anybody who has invested a significant amount of money at the price of 60, it has gone to nearly 86.55. So you can imagine 26 rupees on 60% gain, and provided one has allocated wealth, can create a lot of wealth for the retail investor. Again, NMDC. Okay, we all knew the story of NMDC. We knew that the steel plant will be divested. So all these people who bought at this green signals and all, they sold it off at this point and all over there. They also made a lot of money. Very easy pickings and all over there. The last was NCC. I mean, still Nagarjuna Construction Company. Look at this. There's no graphs and all. I have a 1 hour, I have a day, I have a week and a month. These charts tell me a story which no indicators will tell me. So what is actually happened, the construction space, which I told you, how it's going to play out before the elections and all. So people who entered early, 3-4 months down the line, when they visualize what is going to happen the next 10-12 months, they are the ones and allocated large amount of money. They did it. Okay. So now I'll be sharing the process. Yeah.
You're not uploading?
Yeah. Hide floating meeting for you. Okay. Now everybody seen my screen? Okay. Yeah. Now I only follow 2 tools. One is Screener and the other is TradingView Premium. I started with TradingView, 2 years back, and I started with the basic version. Then I found value in the pro version. Then I found value in the premium version. So I switched accordingly. And Screener I kept. Earlier I used to do a lot of stock risks, what do you call stockage, tijori, trend lines, and all those things and all. But now I have actually filtered out into Screener and all over there. So let's go to Screener. Okay. Now, Screener actually helps you to understand, they give a lot of things, companies, con call, annual reports, quarterly results, and they give a very detailed view of the screens. So before I show anything, I'll just give you a simple thing. Let's talk about say NCC. Again, this is just an example, not an investment recommendation. So what I have done is that I have actually, customized my screen so that at a glance I can make out what is the market cap, what is the current price, high, low, what is the stock P, book value, dividend yield, ROC, return on investment capital, everything, PEC ratio, price to earning, price to sale. What happens, it helps me to understand at a glance, where is the company interested? Can I learn something from this company, how it is behaved? So what is the price ratio? What is the P ratio? So it's got a market cap to sales, everything is there. So you can sales and margin. You can see what is the margin, what is the sale, everything and all over there. You can let it. See what are the pros, what are the cons, what are the other similar companies in that field and all. You can download it in Excel, again work it up and all. Profit loss, compounded self-growth, what has been the growth, profit, stock, return on equity. You can look at the balance sheet. You can understand whether the balance sheet is clean or not. How much is the borrowings, how much is the interest, how much, everything comes in over there. And all those who are interested in cash flows, they know this is over there. In fact, last year when, if you look at the commodities space, a lot of, whether steel companies, whether Tata Steel, SAIL, or even aluminum companies, Hindalco, I think Hindalco, National Aluminium, Vedanta, they cleaned up their budget. I mean, they cleaned up their debt and all over there. So that time there was a commodity cycle boom and all over there. So they cleaned up their debt and it went, the stock went down. So the idea is that once you know the company, what makes the company tick, then you'll be in a better position to decide on which particular company you're going to invest in. Now, these are the normal screeners which I have followed. This one is all my customized screeners and all. Like, like normally in a bear market, I look for value stocks. In a bullish market, I look for growth stocks. This is my understanding of the way in my investment psychology. Because I personally believe, like, value stocks, if I can pick at the right moment at the right time, will definitely do well. So look at this. What is Warren Buffett value stocks? Company is because the recent quarterly results I've done, if I remove it, run the query, it shows me this tree. So normally I run it at the end of every, when a company declares a result, I try to filter out which are the companies which are good, which are the companies which are not. And if you look at the March quarter has ended and most of the companies have come out so far, the large cap and the mid cap space, we are only, 38 days in this quarter. So hopefully by end of May or the first week of June, we'll be in a better position to understand how the corporate India is fared. But two things which have come out very well is that the companies have not done well. Most of their margins have been squeezed. So among the margins have been squeezed and all over there, and they don't see any, there's a lot of headwinds. So one has to be extra cautious in that particular case. So this was end of December quarter when I run the results. It was NMDC, ITCON, NCC and all. So I started investing in Wells Fargo. So invested in small branches in this company, did a more detailed research and start investing in the January or something like that. And has totally scaled up and all. And then sold whenever there was a need. The idea of this screener is that, like, this is what Warren Buffett, I've taken most of his principles, but I've added more of my own understanding, which might not be conducive to anyone. I look for companies where the price to earning is less than 20, price to book value is less than 2, price to free cash flow is less than 20, PEC ratio is less than 1, return on invested capital is at least 10%. Gross profit margin in the last quarter should be at least 50%. Pledge percentage, I don't like companies with a lot of pledged shares by the promoters. Market capitalization is more than 100 crores. Debt to equity is less than 1. And change in FI holding 0.5. I just kept it at that point of time. Normally, I don't look at, I remove the FI holding and see how it comes to. So you can do a lot of permutations and combinations. So you can get your companies based on your own investing style. So then there's a Ben Graham formula, again, which I have customized it based on over there. Similarly, debt to equity, current ratio, return on equity, everything and all over there, because ultimately I require a company which gives, which are much more stable in the market. Again, it comes NMDC, General Polyfilms or the energy. So look at this, both in Warren Buffett and in Ben Graham, NMDC was something which is coming. Now, it's not an investment decision, because the investment, this is just your, once you put your net in the sea, you get some stocks. Then you need to do research and understand how it's going to play out in the next 2-3 quarters and then invest accordingly. So this is something which I look the power play. Any company which is increasing 50% in 1 month, I try to look what is actually driving them. Patel Engineering, well, because Mitra, Datamatics, is fewer. Similarly, I look at the cash bargains. Again, different permutation combination with different things is shown me this are the cash bargains. So I have for more or less for each and every sector, companies with over 20% growth. Again, it shows me which are the companies which are going much faster than compared to the others. So this is the sum of the parameters which I use for filtering on stock. If I want money spinners, again, this is the names which have been coined by me. So these are the ones which where actually the average return, say I look at it this, 5 years back, the return on equity was 15%. Last 3 years, 18%, means I want growing companies, which are companies which are growing. The return on capital employed has increased. The debt to equity is less than 1. Place person is there. Sales growth again has increased recently. So these are the companies which shows up and all. Again, we have to put this in the trading view, see how it evolves, and then take a call. So it's like this. Then let me come to trading view. Yeah, so the process which I follow is that I have the heat map. Normally, I do it on market cap. I look at week percentage, sometimes year-to-date percentage. So you understand which are the companies or which are the sectors which are going. So, okay. And I look at this way and try to understand in the last week, what is the rationale for this companies going. So if you look more green in one particular sector, means they are delivering good results. So the market is expecting this particular companies will do well going forward. So once you do it over here, there's something very interesting over here, performance year to date. The same companies, if you look at this, remove this. And look, which are the companies which have given year to date, which are the returns. And you start going into those companies and you will throw out some names which are not known to many people, but not known to retail investors. So you can invest accordingly. So this is one process which I follow. The second process which I do is that I keep it, because I invest mostly in the mid cap and the small cap space. I keep a track on a weekly basis, what is the small cap and what is the mid cap doing. And then I place my bets accordingly. And if you look at historical in the last 6 weeks, I've been thinking end of April or say mid-April, the mid cap and the small cap space actually has started bouncing back. Because it's a question of reversion to the mean. So 8% was beaten down to 8%. Obviously, if it goes to 10% or 12%, there will be a lot of money flowing into this. Then this is one more thing which I do again on a weekly basis to understand which sectors are actually doing well or what. So for example, in the last week, the MNC sector, Nestle, and the PEC sector have done well. So once you do it and all, you can do it same thing. You can customize on a weekly basis, on monthly basis, year to basis. I can understand which are the sectors which are trending up or moving from a lower point from a lower time frame to the higher time frame. So you can pick and choose companies from that sector accordingly. This is again, I look at the dollar index and all, because the dollar index comes down and all, the metal starts going up, assuming that there's a demand for that metals and all over there. So it gives me a fair idea when to take a risk and when not to take a risk. Last, which I do very religiously, is that I monitor most of the commodities in the world market and all. I have a separate sector for that and all over there. Like the cotton is now picking up, lumber has been picking up, US oil is down. In fact, copper is again, aluminum and gold has started picking up. So I get a fair idea. So you can go back to 1 month, 3 months, 6 months, and see which way it is actually turning it off. Okay, so you can place your bets and understand which are the companies which are. I also monitor the Baltic Freight Index because I know what is the shipping cost, how much the shipping margin will be. At least I know the Shipping Corporation of India or Shipping Corporation of Shipping Corporation of India. So those I keep it space out, because ultimately, see, if we have to go, our imports will increase, the shipping, the cargo sites will increase, everything will increase. So if you can pick and choose and look at when is the rates are changing up, firming up and all over there, pick those companies at one time. So we know the next 2 quarters, those companies will give a very good margin because the freight rates have increased and all over there. Second thing is that it also helps us to understand that the companies which are importing a lot of raw materials from abroad, so how much it will reflect in their bottom line and the margin. So again, I can very guess how much it will be the differential in the final, whether it be 1%, 2%, whether it will surprise the market or it will underperform. So once you go to the commodity and all about there, they have a specific this thing like this. So world commodity trends. So I monitor it more or less on a religiously basis, or at least on a once in a week or twice in a week, to understand how the world commodity market is moving. Okay. Then this is the same thing which I follow, is that, just give me an example. Start with any company, say Engineers India. Okay. Okay, the process which I follow is that I look for congruence in 2 time frames. I normally start with a weekly time frame, then I go to a daily time frame, and then pick and choose on a 1 hour or a 5-minute basis when I'm going to buy. Similarly, when I sell, I look at a weekly time frame, daily time frame, then again I choose a 5-minute or a 1 hour or 15-minute, choose when to sell. Okay, now let's give this company example. Look at this on a weekly basis. So this is the weekly basis. It shows whatever has been the tops, what has been the bottom. The interesting which I always do is that I always look for this 2 weekly basis confirmation. It's a 2 weekly basis confirmation, and I look at the volume. The volumes have increased, and I look at this where it is just quarter and all. I start placing small amount of bet over here. Moment it clears the last 2 weekly trends, I put 100% of my bet over here and let it run. So the idea is that once, instead of looking at the day-to-day or hour-to-hour or a minute-to-minute thing, start looking at the macro picture where the company is heading. If you are more comfortable, you can go for the month and see how the month indicator was to understand. Look at the month. So in 2018, it scaled to 200 rupees. Okay, so this is how it is there. How it's going to play out tomorrow or next week, we don't understand. But what I want to share over here is this. Assuming you have made that one makes an investment, when their 2 weekly candle has gone up somewhere over here, and the market has moved up, and it's averaged up. When the market comes down, it gives a lot of time for the investor who has invested here to exit, right? Similarly, if you look on the same company, look at the day-to-day basis, look at this, how it has clearly gone up, consolidated for a while, again pushed up and pushed down. And market is telling us something that the earnings are going to be declared on 26 May. There's some surprise in the earnings. So whether they have got new revenue streams, whether they've got new work orders, whether there's something that we don't know. We can do, if we do research, we can definitely find out. But this is what it's something has been priced into the market. But at the same time, there's a lot of selling is taking place. There's a lot of long wick. So one has to be very careful, understand if it is very solid candles and over there, then it's over there. But if it's a weak, then one has to take a cross. But if I enter at this price, what will be my stop loss will be? So normally if I enter at this point, so if I look at it on a weekly basis, if I enter over here, I would have entered between this to this, because once I looked at the green candle, I look at the daily candle, and I look at the daily candle on 3 weeks before, and I saw that it started going up. So I will start put more of my money over here. So I'll let it float. So on a weekly basis, I have kept my stop loss to around 3% only. So because now even if it has gone to 10%, 15%, my stop loss will never beat. Now what I will do is that I will move my stop loss to say 90.75. I will make a gain, but our question is I will never give away profit to the market. So if the cashes, I will come out immediately. Of course, exceptions will be there, like I think Manappuram Finance, because the ED rate, the clock crashed and all over that. But fundamentally, there's nothing wrong with the story. It's the market reacting to something and all over there. Because the gold prices or the inherent, what should I say, its value will not get eroded by this. Yes, corporate governance has taken a hit, but let's wait and watch how it evolves. So the question is that if one enters on a weekly basis, knowing when the buying is actually taking place, when the volume is given an indicator and the RSI is crossing the EMA at this particular point, this is the low risk entry, which I normally follow. The other thing which I do is that I also look at the price volume analysis to understand how much actually the buying is happening or the selling value. Just to get a fair idea whether institutions are buying or not buying, and the volume, what is the mean price for that. But I have now reduced to only the first chart which I showed, and this is the one which I always follow. Look at this. Let us look at EIL, for example, from here and see how it looks like. Okay, look at EIL. In the last 3 weeks, it has gone up. In the last 2 months, it has gone up. I mean, something is happening in the company. And the best part is that the last month, or sorry, this month, so it has gone ahead of all the previous months. So this is telling a story. So we have to now go into the research and try to find out how much to invest, what to invest, where to invest, if at all, if it suits our investment appetite. Okay, so this is the this one I shared earlier. I thought of repeating it again because Howard Marks is one of the person I really admire. He actually made an observation, 20 observations of a very successful trader. And whatever he has said is absolutely true. Like if you have one iota of doubt about the company or the market and all, stay out. It's better to have peace of mind and clarity and control over your own trade, rather than investing for the sake of investing or trading just because the sake of trading. And you never overtrade. Earlier I used to trade a lot and all over there. Now I only take, say, maximum 6 to 7 trades in a month. But I ensure I observe that company and then take a bet accordingly, and all. 6 to 7 trades are fine. But then again, depends upon the style of investor or the trader which you are and all. So this is the process to follow. These are all very self-explanatory and all over there. And it's always analyze one mistake. What could I have done better? If I had got exited early, the stock has gone up. what I have not read correctly. Is there more steam in the stock? So, you know, exited a stock doesn't mean you cannot re-enter again. So there have been stocks which have exited or re-entered again at a higher price, because the market ultimately, it's a supreme knowledge. I only can follow what the price is telling me. I cannot tell the price to dictate you have to come down, you have to go up tomorrow. So based on that understanding is that just this is the qualities of a very successful trader. If you can emulate some of them, it will definitely help in your trading journey. So the idea is that one needs to have a strategy. When you enter the market, you should have a very clear strategy at what price you're going to exit, what price you are going to take a stop loss. Once you have your risk management in place and you have a very firm mindset, your profits are going to come your way. One or two cases might be going to be wrong. But if you analyze your trading journal, last year I had around some 85 to 88% success rate. This year, touch wood, so far it's around 94% success rate. I don't know how far it will go. But the question is that it helps you to understand, if you can understand yourself, what are your weaknesses and focus on those weaknesses, ensure those weaknesses are convert into strengths, even in a better position or investor in the market. And, you know, you should never invest without establishing a risk reward. Even if you invest 10 rupees, invest, okay, I can take a 2 rupees loss, I will like 8 rupees gain, I'll come out. But the question is that, you know, or sometimes I've seen people, you know, the market price goes up, they double up their volume. You know, that's one of the, I think, trades a trader or investor should not have. Let the dust settle. The market is not going anywhere. The market is going to be where it is. It is only how we need to train or condition our mind, which is the most important. If we can condition our mind to understand what exactly works for me, what is the risk reward ratio, then only I think we'll be in a much better position to earn more than 7% fixed deposit rates, or even earn more than 10%, 12% and beat in the inflation. You know, whenever possible, trade liquid markets. Nowadays, absolutely, this is my core. Then I got stuck into many companies. It took some time, 3-4 months to come out. Some with minor losses, some with huge gains. But the one thing I realized is that one need to do research. Who are the investors who are holding? If they are selling, who are the mutual funds who are selling? If there's a run on the mutual funds and the mutual funds have hold on a certain company, they are obviously going to liquidate to meet your return. Now the question is why people will say, why FIA sell? Look, if all the FIA money which has been invested based on the Morgan Stanley index, and if there's a run on the equity market in the US, where the normal investor wants the money back, even Cathy Woods will not be able to save the day. See, people have to liquidate their stocks. But the fund have to bring some liquidity. They have to sell from the emerging markets where they have made the gains. Now, everybody said the FIA flows will run up. Everybody has gone. The China is now the opening market. But look what happened. China opened, but as it really opened, look at the way the private sector of China is reacting. Look at the way the chemical companies of China are reacting. If you look at the industry specific news emanating from China, it will take some time for them to sort things out. Okay, because so far they were the global factory of the world, and now post-COVID and all over there, the entire supply chain, the global supply chain, which actually formed post-World War II, 1945, or even say for that matter, 1970, post-1970, post the Vietnam War, when the Nixon, Kissinger came in. The entire global economics, the China reaped the benefit out of it and supplied everywhere. But now the entire global supply chain is now going through a paradigm change. People, multinationals, if you look at it and understand, 10 decades back, 15 years back, India's market share as the overall multinational companies portfolio was perhaps less than 1%. Today, more than 10%, 15%, 20%, the rise in revenue, rise in profit margins for all multinational companies is emanating from India. I still remember one of my friends told me, Unilever India is priced exorbitantly compared to Unilever UK. So you can imagine we have very few good quality stocks and a lot of money chasing it, where it's pushed to a stratospherical level. So the idea over here, what I'm sharing is that India, the market is going to expand. There's no doubt about it. Today you name Netflix. Today you name Spotify. Just imagine today you name ABB. Today you name Siemens. Today you name Cummins. Today you name Timken. Everybody's, or even Schneider Electric, everybody's factory work orders, the next 3 quarters work orders, they've got a, revenue visibility is there. And the best thing is that they have proved their execution skills. There are certain companies which have, please to understand one thing, having a large number of work orders, it's definitely positive, but that does not mean that the company has got good execution capabilities, but ultimately execution matters. Which Dhirubhai Ambani did, which not everybody can be a Dhirubhai Ambani, can he? But the question is, you have to understand what exactly which company or which sector or which industry will flourish in this new change, paradigm shift post-COVID. Today, the multinationals are certain of companies in Vietnam, certain of companies in Mexico, certain of companies in India, certain of companies in Europe. And by and large, they are decentralizing their risk. What do you think? Why did Jim Cook ultimately took a call? Why did he want India? Because he understood that China, whatever is going to happen for now, it's going to be a tapering down growth. Because if I look over the next 20 years, China's growth rate will never match what it did between 96 to 2022. It will never match. It will be on the lower side. Whereas in India, we are in exactly the same stage where the Chinese economy was in the year 1996. And if you listen to Professor Kishore Madhubani, he is a Singapore-based diplomat. He worked in the Singapore Foreign Service, and he was an ambassador to the United Nations for more than 10 decades. Plus, he also held the head policy center. If you look at the speech which he gave it to Kennedy School in UK, in USA, 2 years back, he said, "Is the world prepared to recognize China as the number one?" So just go back to history. In 1945, the US dollar replaced the British pound. So far, British pound was there in the 18th, 19th century. So the US dollar replaced the British pound in 1945. So in the world, in the IMF, World Bank, everything gone. At the same time, the US at that point of time had a lot of gold reserves. So everything was linked to gold and all over there. In 1970s, post-Vietnam War, when there was a debt in the US, then Kissinger convinced the Saudis to use dollar as a element for pricing crude. So dollar came out as a reserve currency, was a demand for dollars, and America went into a happily spend as much as they want without a care in the war. Now, in the next 1 month, the debt ceiling is going to be, it's already reached. So unless the Republicans and Democrats decide by June what to do with it, again, with the recession looming and with the Fed Powell increasing by 0.25, so it is quite a nightmare. Because the US has never seen, the Western world has never seen inflation in double digits since the 1970s. So it's a totally unexplored territory for them. So they don't know the catch-22 situation and all. But one thing they realized is that the growth, the 21st century growth will happen into the Asian century. So China, India, Indonesia, by the way, Indonesia, Bangladesh, Vietnam, they will prosper well. Their GDP will grow and all over there. Just look at the market size. Even if you look at our 30 million market size, it's just much more than anybody in Europe has thought about it. So India provides a big market for a host command of properties. India provides a large number of services. So in fact, at one point of time, which I mentioned the last time also, our crude dollar imports was the heaviest item in the budget. It was around 8% of the GDP. Right now, it's around 5% of the GDP. The turnaround took place during the COVID period when our exports, the IT exports, were much more than our total crude imports. So the idea is that just understand like how the economy has swiveled into the new streams and all. And going forward, auto ancillaries are there. The domestic consumption market is quite huge. And even if there's a recession worldwide, which is likely to be a probability, be it UK, US, or in certain parts of Europe because of high gas prices. So let's understand one thing, companies which focus on the domestic market will need not have to worry. If they can leverage something from their domestic input raw materials from their own mines or from their own factories or ancillaries or vertical integration and cater to the Indian market, that will be more than enough to ensure that both their top line and bottom line increases quarter by quarter. So my idea of sharing this with you is that treat the market, what is the revenue size which the company can expect going forward? What is the bottom line? How much will it increase? What are the raw materials which the company consumes? At what price they are bringing the raw materials? Look at Tata Steel, for example. It is no brainer when Jamshedji Tata set up the Tata Steel plant, he look at the coal fields, what's Bokaro, right? And look at the iron ore and Noamundi. Just tell me one steel plant in the world which has got captive resources, coal and iron ore, within 80 kilometers, or say within 50 kilometers. So the cheapest cost of production is there. Whereas look at the same Tata Steel, bought their plant in UK, the coals and all over there. Look at it unless it converts to green energy, it'll be in a different position. But what I'm trying to say is that look at the company's inherent strengths. Once you get the idea of the inherent strengths, you will understand why the market loves those companies and all over there, and definitely rewards them much better than compared to other companies. This is the lesson which I have learned is that I do not trade every day if the entry point is not arrived. You see, once you become a very disciplined and a very patient investor, investing is nothing but patience. And the money actually flows from the impatient to the patient. What Nikhil Kamath said that in Economic Times, he was awarded the Entrepreneur of the Year. He said 1% of the investors earn more than an FD rate, fixed deposit rate, in 3 years. So you can imagine the amount of money being lost in the market. 99% people lose the money. And if you have to participate in the market and do it by yourself, and ensure return of at least 12% to 15%, you have to walk the talk. You have to really learn, because tips will go a certain way. You will not say, even if you like hit a ball, it might go for 6. You never know. It's like an IPL match. But occasionally you might get bowled or caught too. So you have to be very disciplined, and you have to understand what is your strategy, what actually goes well with you. Are you comfortable with the strategy? Is it in line with your psychology? Are you able to sleep at night? And somebody said, I can't sleep at night. I said, look, what is the size of your portfolio? I said this. I said, what is the size of your other portfolios? I mean, fixed deposit, tapes and all. So I told him is that, as an investor, you should always take your position size in such a way, even if the market in a, what you call a black swan moment goes down 80%, you still have a sound sleep. And that's one of the reasons which I come back, which I started in the beginning of my presentation, I shared with everybody, is that I have a 3 to 5 year time horizon. Coming into the market, it's okay. You can always take a swing trade, positional trade, make a 10%, 15% now or there. But real wealth is created when you actually understand how the country or the sector or the market is evolving, and you position into the companies which are eating away into the profit share of that particular sector. And then you position a significant allocation, obviously not more than 10% in a company, not more than 30% in a sector, and just sit back and watch how the businesses helps you to create wealth. And one must always, define entry and exit points before entering in a trade. This is very, very, very vital, because once you have an entry and exit, understanding of the entry and exit, then only you'll be a disciplined income. It falls, no, let me wait. The market will come back after 1 week, market come after 1 month. It doesn't work that way. Because if you depend on the market to determine what type of investment you will make, then you will not get anywhere. You have to decide first, what exactly, which are the sectors you're comfortable with, which are the companies you're comfortable, which companies corporate governance you're comfortable with, which are the companies balance sheet or profit and loss statement you're comfortable with, and you have to invest in those companies based on your allocation. Then only you can make the money. See, there are only 3 takeaways and all over there. As I explained always, the 10% loss means in your portfolio means 11% your equity portfolio has to go up to just to break even. A 20% loss means a 25%. 33% loss makes a 50%. So you can do the sum. Similarly, if you have a strategy, you have a mindset, and you know exactly you have a risk management in place, you will be profitable. And one of the players, Mark Minami, which I really follow him very much, and he has said a very interesting thing, because he came from nowhere and he had made money for himself. He said very true thing is that don't allocate all your money. If you want to buy a company, break it up, decide when you're going to invest, at what point you're going to invest, and then allocate money accordingly. Because even if you go wrong, you take a 2% hit, even if all your stocks go wrong, you still only lose only 2% to 5% of your portfolio. Okay. So the idea is that never invest large amount of money just for the sake of getting an incremental return in 1 day or 2 days. It doesn't work like that. Sometimes you might be lucky, sometimes more often you will end up in the losing side. Because the statistics always say 1% versus 99%. This is the few books which I've read. I would suggest, I'm sure most of you have read it or not. I would suggest start with The Psychology of Money by Morgan Housel, because it's a brilliant book. Even if you read it 500 times, it will change your outlook towards money 500 times. Because each sentence, read between the sentences to understand what exactly it says. And this are the other books which I followed. Benjamin Graham is again, even after 50 years, 70 years, whatever he said is true. And remember one thing, market has not changed. Market follows the same philosophy which has been doing for the last 100 years. It's only, the human beings' greediness or the ability to control their greed, it actually makes the market move up and down. So you have to decide when to buy, when to enter, when to exit, then only you'll be on the winning side. Thus, there's another one that's, Trade Commodities and Stocks. This book by Laddie Williams, he actually gave me a very good understanding of how smart money works. Because they always buy in such a way they do not influence the market price. They keep buying in small tranches and all. And once they reach a certain times and all, you find that a very positive news comes out in the media and everybody start buying and they start offloading and all. And if you really look, if you look at 4 or 5 quarters of a company, you will realize even if the company gives a good result, it gets hammered down. Because the smart money has exited more than 2 weeks back. So the idea what I'm trying to say is, keep and observe and all over there. Never buy a company just 1 day before the market, it declares its market result, because you never know which way it will go. Or even if you want to enter 0.005% of your portfolio allocation to be on the safer side. And this is my takeaway, is that markets are very simple. It's our minds which makes it complicated. The more you learn about yourself, the more you understand your mind, the more you can control your mind, your mindset, you'll be a winner at the end of the day. Thank you for your kind attention and patience.
Thank you, sir. A wonderful presentation, and that I'll say. Basically, new perspective you have given. Thanks a lot. I have unmuted everybody, and now you can fire your questions. And Mr. Mitra ji here to reply to your all the questions.
Yeah. I have a question for you. This has something to do with the crude that India is buying from Russia. And as we speak, we know Russia has a lot of rupees in their bank accounts in India, the Vostro account or whatever you call it. Now, it is understood that this is one of the reasons why RVNL has been going up. they really don't know how to invest the money and where. The 56,000 crore order of Vande Bharat trains, of which 40% went to, your Titagarh, the balance has gone to TMS, Transmash, which is a Russian company. They really don't know. So what is the implication of this? Because now as we speak, it says Russia is saying now we don't want any more rupees. And they are veering towards the Chinese currency.
Sir, it's okay. I will answer your question in two parts, sir. The first part is that at the same time, is that India also, if my understanding is correct, the way I read it, India has also understand what is going to happen in the next decade and has started, making rupee as a currency for trade to over 19 countries as of date. Now, so far, what we had bought in rupee and on Indian rupee, ruble, and all over there. Now, if you look at it, the BRICS, the economy size, it is going to surpass the G7 by 2027. The total economy size is going to surpass that. Now, for any economy which is coming, they will try to influence their currency. Whether we like it or not, China does more business with the world than the second largest economy, which USA does with the world, whether we like it or not. Even if you look at countries, just take a pause and look at it. Today is 7th May. Just look from 7th of March to 7th of May. Just see how many leaders have visited China. You have the Brazilian president, you have the France president, you have the Spanish, you have the French, you have Australia, you have so many dignitaries visiting China. Even the Brazil, you'll be surprised to note, which I also did when I did my research, Brazil's trade with China is more than what they trade with US. So the Chinese economy actually has taken over the global trading position. And it's obviously the BRICS will take a call whether to go for yuan, whether to go for ruble, or whether to go for rupee, or allow each country to trade in the local currency. One thing for certain, the de-dollarization rate, the speed of de-dollarization will increase, and it is going to increase. Look at the last 2 years, 3 years, look at which are the central banks which have been buying gold. In fact, RBI also has bought gold in this period, because sooner or later, all the currencies will be, my understanding, we will again revert back to the gold currency. I mean, all the currency will be weighted against gold. Russia has gold, India has gold, China has gold. There's a lot of gold over there. So it will there. But the crude which India is bringing from Russia, it's actually, if you look at the economic survey report, we have assumed our crude basket will be $85 per barrel. But actually, if my understanding is correct, and based on the proportion of Russian crude which has come in, we are on $60 to $65 per barrel. So we have a cushion and all over there. But going forward, the world is going to be a multipolar world. So far, it was a bipolar world before the Cold War. Then it became a unipolar world. Now it's moving to a multipolar world. So when you have a multiple polar world, you also have to realize that you cannot rule everything. There's going to be give and take. So the world might gravitate to Chinese yuan currency, might gravitate to the BRICS currency, which is in the works, which I understand will come out sooner or later. But the fact remains is that the Asian century, the Asian currency, be it the yuan, be it Russia, be it India, will rule. But then again, with a caveat, look at the economy size. Today, which are the top 5 economies, and you will know by the end of 2 years, which will be the top 4 economies. So obviously the top 4 economies will actually promote currency which they are comfortable with than any other third-party mediator. So that is one aspect of that. I'm not an expert, sir. You're no more knowledgeable than me, but I'm sharing this something. I don't feel the ruble trade and all will there. Ultimately, say we also have a lot of rubles. We have to play it with defense. I don't know how it will play out.
See,
But
Abhijit,
let's wait
if I
and
may
watch.
interrupt, it's like this. Earlier, we import a lot of defense equipment from Russia. So US, for obvious reasons, is making us veer towards US and other countries. Now, this Make in India, whatever we say, has really not taken off. Okay. Now, this honeymoon period that India is facing now of getting crude at a good price, my fear is it may not last long because Russia is getting fed up of the surplus rupees. They are looking at avenues to invest in India. Now, unless those investment opportunities come, that was my question.
Sir, I believe the investment opportunities have already come. If you look in the monthly, the FI inflows, the outflow which happened in the January and February, and in March it got subtracted because of one investor who invested in the Adani group of 15,000 crore. But if you take that aside, in the month of April, the total FIs were positive. And going forward, the FIs are buying heavily. So the money is flowing in. Now the question is, what type of money is flowing in? That I have not done much research on it, but I'll keep a tab. But look at this way, where else they will invest? Even the Japanese wants to invest over here. Who is investing in the bullet train? The entire Japanese, the money which is lying there, because there's an aging population. They have got so much wealth. They want to invest over here. Maruti Suzuki, they want to set up another factory for exports and all over there. So the exports which are under long-term basis, in fact, JT, they took over the Sono steering and all over there. So now they are in 4 verticals. They are in steering wheels, they are in pedals, they are in brakes. So all those things and also that change is happening. But if you ask me honestly, the pace is very slow. But it's my personal opinion, we will always be a services economy. Manufacturing might take place in auto accessories, might take place in chemicals, might take place in a bit of heavy engineering. But by and large, I don't think it will be. It's more like a give and take. Let's see how it pans out. It's geopolitics as it is. It is very difficult to guess. There's a lot of macroeconomic factors, and let's understand one more thing. The markets will be very choppy. The way I look at it, the markets, mark my words, and I'm talking about the next 10 years, the markets will be very volatile, because what is going to happen, see, whenever a growing economy replaces another economy, be it China replacing the USA or India replacing the UK or Germany for that matter, as far as market caps is concerned, market capitalization is concerned, it leads to a lot of ripples in the world. So until this ripple subsides, it's better to get focused more on the domestic story rather than on companies which are exporting more and all over there. But I believe, like, even if you look at the history of the stock market of 100 years, I'm talking about the global stock market, every decade has shown a positive growth. Not a single decade, even in World War II, World War I, even the 1929 Great Depression, the global GDP, the market cap grew. So let's see. I mean, I have very limited knowledge on this subject.
Thank you very much. I'll take it offline with you.
Mitra ji, I have a question. The way the natural gas and the way the crude is falling during last 1 month, what is your view on this of the Indian economy because of these 2 factors, crude oil and natural gas? Natural gas can come almost to now $2 only. It used to be around 8, 9, 10, even $15. So it is now only $2, and crude also to now around $70 only. So what do you think about this?
See, the way I look at it is that, just break it up into 2 parts. One is obviously from the macro perspective, India stands to gain, which I rightly told you, like the total crude imports or the total oil fuel is now nearly on 5% of our GDP, which has come down from 8% to 5%. So that means that extra 3% of saving we can invest in some other segment. That's number one. Number two, I look at the downstream industries. Look at the industries which are consuming the fuel products and all. Look at the paint industry. So obviously, if the falling raw material price, look at the tire industry. So these are the industries where I expect their margin expansion will happen going forward. So any company where the crude derivatives forms a larger amount of the input raw material cost, they will at least have a 1 to 1.5% or 2% increase in margin in the entire year, provided they have planned it accordingly. That's point one. Point two, I personally believe is not the nature of the company over there. Ultimately, we are investing in the market. So we have to look at the company specific, how it does with that and how it fastly, expands its revenue with the competitors. So the way I will look at it, instead of worrying about the macro factors, I will look at that. Okay, the crude has fallen, fine. Who will benefit from it? Which company in the small cap, mid cap, or even the large cap sector will show a significant reduction in their losses, make profit, make a turnaround and all, and place my bets accordingly. Because at the end of the day, economics is nothing but two words, oikos and nomos. Oikos means a house and nomos means management. It's nothing but a prudent management of one's household affairs. But if you really look at it, it's basically, if the Indian economy will be inherently very strong, because we are attracting now the world's capital. It is not very easy for a company. Plus, look at this simple example. Look at Apple. What is Apple market capitalization? It is more than our India's market cap. Okay, so just imagine an Apple, a company which is investing in India, that company's market cap is more than the Indian market cap. So if all these big players started investing in India, which they have already done, and going forward, if India's share of their revenue and their profit increases to at least 15%, 20% of their global, then India has got a fantastic story in the next 10 years. I don't see any obstacle. I don't see any negative thing which can happen. How can it affect? And look at the way India has positioned themselves. India has never allied with anybody. India has absolutely been at its own path. I mean, that's my way of taking it. And if you look at the oil marketing companies, yes, they will definitely gain, because then again, but then the question is that the GRM will fall, if I'm not mistaken. So, and the second thing, being an election year, you know better than all of us, like how much they'll be afford to raise the prices. So again, it's a no-brainer. So my understanding, my takeaway is that focus on those companies which are nimble, which have got their own market, which nobody else can penetrate, and focus on those sectors. That's all.
And one more question on the banking sector. Why suddenly the bank Nifty has gone so up during last 3 months? There was some specific thing happening in the banking industry, or is it just now operators are playing?
Sir, you and I don't know who the operator is. I leave it to the wisdom of the.
Why the Nifty has gone so much?
But as a small retail investor, the only thing I would say is that, these are very big questions, no doubt. But if we really look at it, if you look at the Chinese economy, if you look at the American economy, even if you look at the UK economy, if you study how they have grown over the decades, see, the financial sector has to go. There's no doubt about it. That's number one. And that's already happened. Otherwise, why would Mr. Kamath or Mr. Aditya Puri, why did they actually look? Because they looked 30 years, 40 years down the line, what would have happened? Because as the economy goes, the financialization of the economy is going to go. Now, we have to understand what are the factors which are driving this financialization. So the factors are namely, is that one is GST. So how is the GST playing out? So GST, again, look at this, it's been raised for the destination states. It's not the producer states. So the states which are having a large amount of consumption, so the GST across, so suppose I manufacture in Bangalore, and I sell it in Maharashtra. So obviously the IGST portion is given 50-50 center and the state. right? Now, what is happening is that the south and western part of the country have a very rich industrial base, has got a rich automobile base, So they are going to have a higher GST. But you look at the GST, the consumption, whereas the east is basically agriculture and services, and to a certain extent mining, right? So what happens is that the GST is going because a large number of companies have realized if they have to claim input tax credit, they have to come under the tax. They have to pay GST. So the share of the unorganized sector is shrinking. The share of the organized sector is increasing. This is happening across all industries, sir. Paint industry, pumps, bicycle tire, wheels, ancillaries, everywhere it is happening. That is what. Second thing, what is driving is that once the government is assured of a certain inflow of revenue, direct, indirect tax revenue on a monthly basis, the government in a much free position to realize which particular segment they are going to invest in, so that the engines of the economy starts humming. Now, coming back to your question, the bank, just again, let's split up banking into two segments, or rather two different categories. I will look at this way. One is private bank and the PSU bank. All of us knows where did the story went in the past 2 decades, why most of us have shifted accounts from a PSU bank to a private bank, right? We all know what happened with the NPA, which got cleared up in the last 5 or 6 years, and all other banks cleaned up their NPA, how the mergers took place, and now which has been re-rated by the market. That is one part of the story. But going forward, the share of the private banks will definitely go at the expense of the PSU banks. The question is, why is it so? The question is quite simple. Is that ultimately you have to invest in consumer analytics, you have to invest in backward integration and over there, and ensure that your platform is available not only on the mobile, it's available on the net and all over there. So until and unless a company, that's a private sector, they invest more money on this, the back-end support and all. I see very rarely, even if it happens, so most of the banks in the PSU sectors have been merged by 3 or 4 banks together. Obviously, in any merger, as you rightly know, is that the cultural fit has to take place. It's a big challenge for the HR of that company. That left aside. So 2 things are given. Private banks will increase, the PSU bank share will go back. Now, the most interesting thing is that as the non-bank financial corporation space, the NBFC. The NBFC, look at Bajaj Finance. Okay, let's give an example. Look at Bajaj Finance. Look at Poonawalla Fincorp. So their share is increasing. At the same time, if you look at what the RBI governor declared in the last meet which he had with all the bankers, he said be very mindful of your loans. Because if you really look at it, that the last 3 quarters, most of the banks which have grown have given unsecured loans. And God forbid if anything happens to that economy. Look what has happened in the IT sector, for example. The IT sector, the attrition was one part. Now, induct of new employees have come down. That is number one. Till they see the revenue visibility in the next 2-3 years. So what is actually impacting, just imagine, look what is happening down the line. The IT companies, people, they used to have a decent amount of income which can afford EMI of housing loan of 1 lakh rupees per month. You just tell me how many sectors in India can afford a EMI of 1 lakh per month in a real estate. So if that demand shrinks, the real estate will shrink. So it's a catch-22 situation. So what I'm trying to say over here, why Bajaj Finance? I don't think any Indian in the country has not received any call from Bajaj Finance in the last, say, 70 days. Because they have actually gone over aggressive and they have done their own, what you call, algorithms, or so you are the expert in algo trade. They have done algorithms, they have done data mining of their customers, which are way, way far ahead. And they thought of it 10 years, 15 years before. So the idea is that anybody who is having a large amount of mining of customer data can make wealth. And what I foresee is that there will be a merger of communication companies and banking companies. Banking companies might be in the front, fintech companies will be in the back, because that's ultimately is going to pay out is that. Because look, when in South Korea, when the internet bank opened, it pulled in more deposits than on what the normal bank does at a day. And how many of us have actually visited a physical bank branch except for very few occasions? So everything is moved online now. So we don't even know where our bank branch is located. We always do everything online. So the financialization of the economy will increase. Banking sector will go, but again with a caveat, CASA will not go as it was there. It will be very difficult to get, good amount of deposits at a very low rate, because ultimately, if you look at it, what is the banks which is given a 2%, 3% interest? SBI, ICICI, HDFC Bank, and there's the money which we are doing it. Instead of keeping the money in the bank, if we have invested in FTBs, we will get much better returns. But that's a different story. But what I'm trying to share over here is that the financialization of the economy is bound to happen, and it will expand at least 4 times in the next 15 years. So if you look at a long term, yes, there were hips and guts. And by the way, IDFC First Bank, Mr. Vajanathan has actually walked the talk. But next year will be a bit difficult, in my opinion, because the headwinds will start flowing.
So questions from other members? There was some question in the chat also. You can ask your questions now.
Let me look at the chat.
Yeah.
I will look at this, please. Okay. Let me just go up. I'll start with Kamlesh. He said portfolio of 1 crore size. How many scripts at each point? I would suggest, I'm not a SEBI registered advisor, I'll repeat over there. But if I buy in your shoes, I'll start investing 20 lakhs in 10 or 15 stocks. And slowly, once I get a firmer idea of the company's shaping up, I'll start pulling more money into the winning stocks and less money remove the money from the losing stocks. And at any point of time, I'll play my money with 10 or 15, but I will not allocate more than 10% allocation in one particular company or 30% in one sector. And the second question is liquid market. Liquid market is basically the market where you can, liquidate it very easily. You have short-term liquid funds. You have even equity market has now become very liquid, provided because a lot of buying and selling happening in millions and all over there. So even if you put a 10 crore buy in a Coal India share or even the State Bank of India, you can get the money back in T+1 day. That's what I mean by liquid market. Whereas in a micro cap company where there's less float and the promoter owns, or as what Mr. Kothari said, there are certain investors who are pushing pump and dump scheme. So there it is very difficult. So you have to understand how much is the float of the company, how much is available, and whether the price when commanded justifies that. I mean, put yourself as the owner of the company, whether you'll be comfortable with such high valuations. So my idea is that, pick something which is more comfortable to your own understanding and knowledge. The macro view of growth India, I've already explained. Simply to save in Nifty index fund for the next 5 years. Yes, you can do that. See, ultimately, if you really look at it, see, most of the mutual funds, they underperform. Have anybody analyzed the reason why they underperform? They invest in, you can go to value research, or you can go to platforms like Market Mojo or you MarketSmith everywhere. So you try to understand from the mutual fund manager, they deal with 50, 60 companies. They have a certain proportion of small cap, mid cap, large cap. They have to get their thesis approved by the investment committee, even for buying and selling. So they are not as nimble-footed as we retail investors. We are very, very lucky in that respect. We can turn around like anything. Whereas they have to go through the paperwork to that. And normally, if you really look at it, the mutual fund managers, they always try to do 0.5%, 0.25% more than the Nifty. That is the benchmark. So if that is, and they keep only 1 or 2 stocks in their portfolio where they have a lot of liquidity, they buy more, sell, and buy, sell, like that, they make the profit. So instead of doing all that, why don't you think it's better to buy a ETF tracker, Nifty ETF tracker, a fund, index fund, which gives you tracking at a very low error. At the same time, the investment cost is also very less compared to what the mutual fund charges, even on the direct route. So that will be in a much better position. And obviously, the economy will go through ups and downs and all over there. But the question is, if you look at in the going forward, we will definitely be in a much better stage. The GDP will normally doubles every 5 years. We'll start doubling hopefully by end of every 48 months or say 54 months. That's the way I look at it. And we estimate the intrinsic value of a stock, keeping a good margin of safety and buy it at discount. When a stock does not have a hold on the stock. A very interesting question. Yes, intrinsic value, extrinsic value, everybody has got a role. Question we have to really understand is that's one part of looking at the stock. The other part is that understand it from the point of view, why will the market re-rate a company? Let's look at from a very fundamental perspective. Why will the market re-rate a company? Or why the market is ensuring that the intrinsic value is high, the extrinsic value is low, which happens in the case of holding companies, right? If you look at any holding company, look at Tube Investment or look at Bajaj Holding or look at, what is that? I think Sundaram Clayton or even Tube Investment here, which has got CG Power and investment. So investment companies, they have a high intrinsic value, less extrinsic value. The question is, you have to understand whether the company will be able to show a 12% gain in the top line and a 12% gain in the bottom line going forward. If this is not able to show, if it's not going to lead to an increase of earning per share, why waste money on that company? Put it in a fixed deposit, at least get a 7%, 7.4% at the case of that. Right? CP Nifty is better than index mutual fund. Again, it is one personal choice. You can do best on your own person.
Yes, sir, I would like to reply here. SIP in Nifty Bs will be significantly better than index mutual fund for a simple reason. Ki Nifty Bs you can buy any time during the day. Anytime. That means suppose market is fallen by 200 points or 300 points. So you will get the rate of that particular moment. Whereas in case of index mutual fund, you will always get the NAV at the end of the day. So suppose the market is fallen by 500 points and again it is going to come back to the same level. So you will be getting NAV of the end of the day in case of index mutual fund. But in case of your Nifty B, you can buy during the day. You can stagger your movement. You can buy 10, 10, 10, 10. You can buy 20, 25. Average out. Everything is possible in Nifty Bs, which is not possible in case of index mutual fund if you are buying through a mutual fund. So I thought just clarify. So any other questions? अरे आज तो क्या क्वेश्चन बहुत कम आ रहे हैं, क्या हो गया? सब लोग सोच रहे हैं लगता है. आपने इतना फूड फॉर थॉट दे दिया है ना मित्रा जी. So that is the reason. तिवारी जी आप कुछ बोलेंगे?
सर इतना अच्छा एक्सप्लेन किया तो फिर पूछने के लिए बहुत कुछ बचा नहीं ना सर.
अरे आपका इनका स्ट्रेटेजी तो बहुत सेम चलता है ना. आप भी तो वैल्यू बायर हैं. आप वैल्यू बाय करके फ्यूचर बेचते हैं. तो आपका स्ट्रेटेजी बहुत मिलता है इनसे तिवारी जी से, इनसे मित्रा जी से.
सर इन दिनों में पेट्रोलियम कंपनियों के लेने चाहिए ना सर, क्योंकि अगर क्रूड इतना डाउन है, सो लेट अस से HPCL और BPCL वी शुड गो फॉर दैट ना, बिकॉज दे आर नाउ हैविंग वेरी लो रॉ मटेरियल कॉस्ट एंड ऑल दैट.
Sir, let me ask you this way. What do you consider a sunrise industry and what do you call a sunset industry? So for my mind, it's a sunset industry, right? Just tell me which oil exploration company, I'm talking about Shell and the top 5, whether they have made any allocation for deep sea investing or shale mining or shale cracking or fracking as you call it. The answer is no. Why they have switched over to renewables? Why they are ensuring that our share of green energy comes over there? There's one interesting video in the Shell website, Shell in the year 2018. If you have not seen it, please have a look at it. You will understand what the world top oil company is talking about. So a market always looks at, look, when Henry Ford bought out his first automobile in the year 1910, you had only horse-driven cars, right? You had only 1 or 2 Ford cars. In 1 year, it was all Ford cars. Now, every fuel has got its life under the sun. Look at James Watt's steam engine, coal, right? Ships, right? Look at diesel. It all started with tanks in the World War II, right? Vehicles. So every petroleum product has got its sun. 21st century is basically gas. 21st century is basically renewables. Now the question is, when will it happen? How will it happen? Whether it will happen or not in our lifetime, that's a debatable question. But the question is, the market does not give much command. These companies will not command much premium because it's a sunset industry. Now you can always enter and get away with a 10%, 15%. But will it double your money in the next 10 years? That's the question we should ask.
Well, the message is very clear. Message is very clear.
Yes, yes.
Because the way the
Mitra
electricity
ji?
is coming, way your renewable power is coming, the future of OMC companies is not very good. That is very clear. Boliye.
Kothari ji,
Yeah.
can I ask another question?
Boliye.
Abhijit ji, ऐसा है कि if you look at the government companies, like of late you were talking about EIL, RVNL, IRCTC, blah, blah, blah. Now, earlier, I remember last year when you had taken some sessions, and even Kothari used to say, the government companies, the PSUs, are all victims of government policies which can change. Now, suddenly you will have a windfall tax, suddenly that goes. So therefore, but now you see RVNL, your IRCTC, Railway Finance, now you are talking about EIL. Now, why that shift?
So let's look at this way. One thing for certain, yes, the defense sector, the railway sector has been a lot of focus because of importers, we are going to go for exporters. You look at the vision in both the defense ministry side and the railway ministry side, the vision is very clear that we will manufacture everything in India and we will export it. And there's some huge market, yes. And in the defense sector, if you remember the ordnance factory boards, they have all been now been corporatized. So yes, definitely that shift has happened. And there's a lot of unlocking of value. And the other interesting part of this is that these companies are not going it alone. They have done tie-ups or joint ventures, which are large amount with large number of companies, be it Siemens, be it ABB, be it other multinationals also. It's not they're going alone. So what I'm trying to say is, yes, it will be. But the question is, see, as an investor, whether we will get married to the story or that somebody has asked how long we are going to hold a multi-bagger, it all depends upon your psychology. I'm happy with a 25% return. I don't know whether you will give to 100% or 150% or not. I'll be happy. I will buy if I find there's certain worth it and all over that. The other reason, sir, is to answer your question is that the government is looking into unlock value, because if we look at it, all these companies, government or the LIC, Life Insurance Corporation, they are the major investors, right? So they will try to offload, which they have done with BPC, HPC, and other companies also. So slowly you find offerings like in Tata Communications, also the same thing happen. So the government is also trying to unlock the value which they have invested in and all over there in those companies. Like selling of Air India to the Tatas is one way of hemorrhaging the loss. That's another way of looking at it. So this sort of stories will come in across investment cycle, 1 year, 2 year, 3 year down the line. Question is, as investors, how do we make maximum use of the opportunity, enter at low risk point and exit at high risk point?
Good afternoon, sir. This is Rajiv from Hyderabad. Mitra ji, can I ask a question?
Yeah, go ahead.
Please.
Yes, sir. This is regarding investments, like IRB InvIT, PG InvIT, REITs and all. Is it wise investments because they are good at their, I mean, what you call base value for some times, and also dividend distribution is good.
I'm sorry, would you just rephrase your question, please?
Investment trusts, PG Invit, IRB Invit, and real estate
Okay,
invest.
okay.
No.
Okay, okay.
I
See, it's
have
like
I
this,
have taken invested in IRB Invit, as you said that from 40 rupees to every rise whenever I have capital, I kept on putting. Considerable size is there right today, and also good dividends I'm getting. Also, there was a bit of appreciation, around 20%. Is it a good investments for aged people or who had a free capital?
so I will not go to the second part. First part, I'll try to understand based on my understanding. Yes, this commercialization of real estate and through this Invit Trust and all over there, you have got Brookfields, you have, I think there's one more Indian player that's what's happening. But see, what they are doing is that they are buying into the commercial spaces, and whatever the revenue is flowing from the leaseholders in the commercial spaces, then money is been distributed as dividend, correct?
Exactly.
That's the way. Okay. Now just look what actually happened in the last 24-month cycle. Point one is that all those people who wanted to invest in real estate post-COVID, that hunger for the purchase for real estate has come down, right? So obviously no new real estate, nobody is buying, or for the matter, if it is buying, it is very less than just post-COVID, initial post-COVID days, or even the last quarter days, say July to September, that quarter, or April to June. So why this is happening? It's just to understand something. If the interest rate rises, the EMI starts rising. Either you have to increase your number of years, or you have to, ensure a large what you call pay upfront to keep in the same EMI. So that is one way of looking at it. Second thing is that most of the pent-up demand in the materials segment has gone for phase. It's like it's now the pre-COVID days. Most of the demand is now in the pre-COVID days. That pent-up demand for 20 months and all, that actually shut up the economy and all of that. Now we are reverting back to the lean. Now, if you ask me on a 10-year period, you always need to understand it's not possible for everybody to allocate 100% money to equity. You need to allocate, say, 10% to investment trust, which you have said real estate, 5% to gold, 5% to insurance, 5% to fixed deposits, etc., based on your need. So my takeaway will be is that, so if you have no requirement of the money, just wait, because what I personally believe, there are certain segments of the economy, there's a lot of investment is happening in the commercial space in the real sector, and a lot of it's happening because if I look at Night Trend report, or I read it 4 months back, so that shift is happening. So once the election's over, which is 1 year down the line, and it will be more clarity as far as the financials are concerned, I think we will get, but definitely the 12%, 12.5% dividend which you used to get, that return will not come. And I'm also making one more prediction, is that the interest rate, which we have gained 8%, 7.4, 7.5%, in the next 10 or 15 years, will taper to 3% to 4% to 2%. Okay. So if you get a chance, this is bound to happen, because this has happened across all economics, across, just a second, please. This has happened across all economies of the world and all, because as the economy expands, the interest rate keeps coming down. It will only go up in case there's inflation at the central bank of the country, whether it's Euro or London or for that matter, US. they start increasing the rate proportionally to right now it's 5.25. But that aside and all, expect going forward, there will be a softening of annuity rates. There will be a softening of interest rates. Inflation will be sticky, will be 5 to 7%, again on a decadal basis, which I'm saying. So equity is one aspect, but again, if you invest wisely and in proportions and manageable proportions, I think we can ride it out.
Okay, thank you. Thank you. Ji.
There are 2-3 more questions in Q&A. Mitra ji, आप देख लेंगे उनको, and then we'll finish. One is how long you should hold a multi-bagger.
Multi-bagger, okay. The question is, sir, it all depends upon your own entry and exit policy. If your entry and exit, as I always said, that you should decide at what point you're going to exit, at what point you're going to enter. Whether you're going to be a passive investor. If you say everything is going fine, you will allocate more money till it reaches 10%. If it is going fine and you have got no need of it, fine. But if the market takes a downturn and the company is in the stage 3 or stage 4 of the evolution of the graph, I think you need to exit. See, a question of multinationals is that if you look at honestly, look at HDFC Bank, right? Now, last 5 years, tell me whether the HDFC Bank has beaten the Sensex. No, the answer is no. So the question is that what we perceive as multinational must have run down by this value. Look at Maruti Suzuki, right? Maruti Suzuki price once upon a time was 10,000 rupees per share. And after that, if you look at it, if you look over that, it's never reached that particular stage. So the question is still a multinational, but you should have, if you're a very, if you are monitoring investment, you should have exited at 10,000. When the second weakness signal was read, it was very clear the smart money is coming out from it. So to answer your question, there's no concept of multi-bagger. It depends upon your entry and exit targets which you have set for yourself. And once your exit target has come, then whether you take a fresh call, whether I will hold on or not, again, subject to those parameters at that point of time. Okay, Mr. Vikas Mehta, how do you see the prospects in sectors like infrastructure and IT companies? Okay, I'll answer it in a long-term perspective. I'll start with IT companies. They're going to do well. Okay, the question is, what makes me so optimistic? First of all, is 2 things. Very clean balance sheets, large amount of reserves. If nothing happens, they will buy back their own shares. So that one part of that, they don't need to invest or borrow money. So that part is taken care of. Management is very nimble-footed, knows which are the verticals which will rise, and they are allocating money and people in those sectors. Thirdly, the Western global world will shrink. So if you have more unemployment, so the trade-off will be more computerization, like more digitization, which will take into the work like AI, artificial intelligence, chatbots. They will take out the work of many. So if I drop off a manager who's earning high salary, I will obviously ensure my IT infrastructure has been moved to the clouds to take care of it, even from remote working from anywhere in the globe, right? So the IT companies will be hits and downs. Overvaluation was one part, which again, too much money flowing and chasing a few IT companies, again, which Accenture showed in the report, has come down. But then I would always say, if there's another market crash, you should start nipping. In fact, LIC has already started in the month of April and March. They have invested a lot of money in the IT companies, but there was attractive valuations and all. They have actually increased more allocation to the IT sector. So that's one part of the question. The second thing is that infrastructure. Now, infrastructure is again, it's up and down. It's like more of a commodity play. Before election, it will shoot up. Post-election, it will come down. So it's like this. It's a catch-22. Cement prices going up means you can expect the infrastructure companies will have a margin squeeze. So it's more of a short-term cyclical play than ultimately all plays are cyclical. If you look at a 15-year, 20-year, 30-year cycle, all the cycles. But IT has got some steam left. Infrastructure is on a shorter basis, it will move up and down. Next question, few months back, stock related to solar, wind energy, but nowadays the sale back. What could be the result? So there's always an up and down in the market. Volatility is given. The question is that people chase the stock because that is the story in town, right? Now the story has gone and the results have come. The results have not been up to the market's expectation. It's going to get beaten down. It's as simple as that.
Yeah, that was the last
Okay.
question.
Yeah.
So if there is no
No,
more
one
question,
question.
boliye.
So, sir, one question. So, according to the methodology that you use, if we just go and stick as per that, and we shortlist, let's say, 5 companies which are as per the shortlisted screeners, and we look at their performance and their fundamentals, would you say that if you take, let's say, 20% of your capital and put it in 5 companies, so I can go ahead blindly with that, or do we need to do more research?
No. It's like this. Say once you identify a shortlist of 5 companies, okay. So assuming say you want to invest 1 lakh in each of these companies, correct? So my submission will be to invest only 20,000 rupees in each company and enter at the lowest risk point. That's number 1. Moment the company starts going up, the price starts commanding attention from the market, you add another, say, 10,000, 20,000, like that, you scale up. So you average up. So what happens is that at any point of time, your average buying price is always less than the current market price. You understand what I'm saying?
Yeah,
Okay,
got it.
so what happens is that by chance, if the market cycle changes and you see on a daily basis, on a weekly basis, the strong candles have been forming and it's down, and also the RSI EMF crossover suggesting a downward trend, you can exit. Just nothing stops you. If you like that company, you can again re-enter, and again at a price if you feel the story is got enough steam, right? So that is the way I would play it.
Okay. Thank you.
Thank you. Thank you.
If there are no more questions, then we'll end. Mitra ji, thank you very much. Your presentation was a long due. It was postponed 2 times because of some other issues. So thank you very much.
Thank you, sir. Thank you.
Thank you a lot. We always know. I always feel happy when you give